Welcome to the Daily Fortune, where we talk about the latest topics about finance and investment. But before that, please don't forget to click the like button, subscribe, and hit the notification bell so you'll know when we upload a new video. Now let's get started. Copper prices doubled last year. Sugar has also increased by 50% over the past 12 months, and wouldn't you know it, oil as well has doubled its price. Prices are increasing. Everything seems to be getting more expensive now. And get ready, because cryptos, stocks, and real estates are going up as well year after year. Okay, now let's get to the main part. There's this huge bubble that's about to pop. But what is this asset? And what impact will it have on the economy and other asset classes? Just keep watching to find out. The CEO of Ark Cathie Wood, has spoken about this asset. Because of the pandemic, consumers spend the most on goods rather than on services. Yeah, we're forced to stay in our homes, no work outside, and some businesses were forced to shut down. Although over the last months, there has been an unusual trend that turned into a huge bubble. Consumers spent more on durable and non-durable goods. They only spent their money on those items because the services were shut down during the pandemic, as Cathie said.
What did the consumer spend on? Goods, non-durable and durable goods, because those were the only items that consumers could spend anything on. Services were pretty much shut down. Now, what's interesting about this is goods make up actually less than a third of all consumer spending. Services make up the rest. So for the past year, the consumer, pre-vaccination especially, was focusing his or her spending on goods, just a third of a typical budget. And consumer spending rose as a share of total spending to more than 40%. I don't think it's been that high in the United States in quite some time. As a result, we believe that consumers have actually been building inventories themselves at home.
She also believes that this is unsustainable and that spending in this area will go below 30% in a matter of months. As a result, businesses will be left holding the bag because they will have a high inventory and the same amount of anticipated demand. Computers, air conditioners, and washing machines have all been purchased by the majority, so we don't need to purchase any more new computers or air conditioners or washing machines or any of the sort because we already own them and we can use those for a long time. Service purchases are rising, while commodity prices are dropping. However, because consumers' spending on goods hasn't decreased considerably, item prices have climbed. And because businesses haven't been able to match the strong demand, they've placed massive orders for materials for their supply chains, causing those raw material prices to rise. And so the price of raw materials is soaring, with lumber costs roughly 4 times what they were just a few years ago. Consumer demand for goods is beginning to rise, surprising businesses that have been struggling to meet the high demand. Consumers are spending more money on services such as eating outside, traveling to see friends, and going on vacations as COVID-19 vaccines are widely available and practically everyone has been vaccinated and had their booster shots by now. But it's all coming together and the results will be disastrous. Businesses are still scrambling to catch up on inventory levels, which are at an all-time low. As a result, businesses will lose revenue and will become more concerned about the situation. The scramble continues after that. For the moment, the consumer's attention has shifted to services. In April, retail sales were unchanged from the previous month. They were expected to rise by 1%, but already had risen by 10.7% in the preceding months. In comparison to expectations, it was really a pleasant surprise. But here's the biggest issue here. The businesses that sell items have placed an excessive quantity of supply orders. Businesses that sell things will have to cancel a major amount of their orders for the materials required for their supply chains, because consumers have already stocked up on goods and are now spending on services. Commodity prices will fall as a result of these cancellations, having an effect on other asset sectors such as stocks and real estate. Also, just let me remind you guys that this isn't just a wild guess on Cathie's part. Her notion is backed up by data and current figures on consumer spending.
If you look at real consumption in April, it was down slightly. But if you look at real goods consumption in April, it was down 1.3%. Now, this makes sense because if you look at the past year, real goods consumption increased 74%. Think about that. In the last year, the consumption of durables has increased 74%. And so now that the consumer is filled up on durables and I'm sure non-durable goods as well, the spending towards services has begun. And we did see services consumption up 0.6% that month.
Commodities are fast decreasing in this kind of situation. The commodity bubble has been fueled by businesses ordering massive amounts of supply. Commodity prices are about to plummet as a result of these cancellations. Cathie draws a comparison to Wile E. Coyote falling off a cliff like when he's suspended in mid-air trying to run back into solid ground like in the cartoons. Commodity prices are on the edge of a cliff and have plummeted dramatically. Let's use the price of copper and lumber as an example. The price of copper reached $4.90 down to $4.50. Lumber prices peaked at $1,711 and dropped down to $1,200. If we look at it closely, that's a significant drop. Currently, it's just hanging below $1,300. You may be asking, how will this influence other asset classes in which you may have invested in, such as stocks and real estate, since we know there will almost surely be a commodities price crash? Falling commodity prices will serve as a deflationary effect since product prices would decline as well. As a result, inflation won't be as high as anticipated. Cathie is witnessing these investor predictions right now, as bond yields are falling, showing that investors aren't as concerned about inflation as they appear to be.
One other indicator very important to us is beginning to confirm that this might be a little bit more real than the skeptics would suggest. The Treasury bond yield has dropped from 1.75%. This is the 10-year Treasury bond. So 1.75% to 1.55%. And today we got the wages higher than expected. We've seen inflation indicators higher than expected, as I just mentioned, and yet the bond yield is going down.
As a result, inflation indicators are currently higher than anticipated. Bond yields, on the other hand, are dropping, indicating that as commodity prices fall, investors expect inflation to be lower than expected. All investors should keep a watch on the bond market because it provides clues about what's to come. Every recession, for example, was preceded by an inverted yield curve in the bond market. In fact, the bond market predicted skyrocketing energy costs in 2006. Rising commodity prices and inflation have caused value shares like energy and financial-related companies to appreciate significantly in the short term. I'm sure you've observed that Tesla and other growth-oriented stocks have dropped. Road stocks, on the other hand, may gain from lower interest rates if commodity prices plummet and inflation falls short of expectations. Furthermore, because of short-term recovery growth rates, value-oriented corporations have risen. When recovery spending falls, these value stocks will lose their attraction in favor of growth companies that are growing at a faster rate.
As we've been saying for quite some time, that the bull market is alive and well, and it is broadening towards value and cyclical sectors. Or maybe I should say it has broadened. This has happened, and we thought it would. And we thought it would hurt innovation-oriented strategies. It has done that as well. Now, if we're right and everything I just suggested based on the evidence we're seeing occurs, then these cyclical sectors are setting up for a fall. And that should accrue to the benefit of innovation.
Today is the perfect time to make long-term investments. Cathie agrees that this is a great opportunity. So that's it for today. I hope you learned something from today's video. And to get updated with the next videos, don't forget to hit the notification bell. See you next time.